So a lot of us have heard that the consumer is strong, but yet there are tensions around the world. So let's take a look at some of the key data points that talk to the consumer. US consumer confidence has been up at over 90 levels since 2017. That's pretty encouraging. Unemployment rate is at its lowest that we've seen. The US dollar is strong, which is supporting spend here and abroad. And then we have interest rates that are low, which are supporting housing in the United States. But still, there's tensions. US-China trade war, whether it's the Hong Kong unrest, or whether it's moderating GDP assumptions, forecasts at China, and even Brexit in Europe. Putting all that together still, we have pretty robust outlooks on the luxury market. Our BI analysts believe that the luxury outlook will be for a 7% increase in 2019, and we will see some moderation in 2020, but it'll go to 5 to 6%. So it's still good. And then if we think about the Hong Kong market and what it's really done to luxury, the market was about 6 to 7% of luxury sales, and it's now less than 5%. So there is disruption there, but that disruption we hope to see moderate into 2020. And holiday, without talking about holiday, we can't stand here since we're in the middle of it, holiday projections are also robust. We're expecting holiday sales to rise by 4 to 6%, which is a mid-single digit gain over last year. That said, not everything will be great in retail. If you look at the charts here and you focus on the white line, that's the S&P 500 through the first half of November year to date. And what you can see is while we have robust gains in the market, not all retailers have gained. And the two lines below in green and yellow you'll see is department stores and specialty apparel stores. And as we know, those retailers have struggled. These are the legacy traditional retailers that really have had the hardest time driving traffic into their stores. But not all retail has been bad. The luxury market and athleisure, when you think of the Nikes, the Lululemons of the world, they've done really well. So taking a look at this chart here, Lululemon stacks at the top of the list. Why they've done so well? There's a couple of things that they're doing right. One, the product is right. Two, the marketing is right. They truly entrench themselves in what they sell. They connect with their communities. They host runs. They host yoga classes in their showrooms. They're immersive in their consumer experiences. And then if you look towards the bottom grid, which is the specialty apparel retailers, really it's mixed there. And what stands out to me is value. So if you look at the green top section, you'll see the retailers that are listed there, whether it's TJX, Ross Stores, or Burlington. The reason they're thriving, and even if you think about Walmart or Target, they're thriving because they offer value, they're convenient in off-mall strip centers, and they connect with the consumer that they're going after. For luxury, the story is a bit mixed. You can see that LVMH, Kering, Hermes, Montclair, and others are doing really well, and even US monobrand companies, but it's the aspirational mid-tier luxury that's struggling. So when we think of the Coach, the Kate Spades, the Kors of the world, they're not doing so well. In the latest quarters, their sales were down, and that trend could continue as luxury creeps into their space. So when you think of the higher-end luxury brands, they're all now offering price points that are in the league of these mid-tier aspirational luxury brands. And that encroachment continues to hurt their sales, and we don't see that changing anytime soon. So what's causing the real disruption in retail? We've heard it's digital, online. People are shopping online. But in reality, only 10%, a little over 10% of retail sales are done online today. That's a small number, but when you go into the legacy brick and mortar retailers, if you were to look at a Nordstrom, it's 30%, so it's much higher. A Williams-Sonoma, it's 50%. And then if you looked at Aerie, which is a brand of American Eagle, it's about 40%. So the numbers are much higher, and I'd say on average probably around 25% of legacy retailers' brick and mortar sales or their online sales are from the online channel, their total sales. And really at the heart of this disruption is mobile. So if you were to look at mobile and just to see in all of your hands, I'm sure everyone has their mobile phone and they're connected to it more than they are to anyone or anything else. And that's the driving force behind this disruption. Mobile sales are expected to represent 60% of online commerce. That's astronomical compared to where we were a decade ago. And that trend continues and is really causing the disruption that we see today within digital. So retailers are going omni-channel. That's happening. We see that, and it's here to stay. You just heard about pop-ups most recently. You can argue whether pop-ups are more expensive or less expensive, but most retailers and brands would say, depending on the location, they're a cost-efficient way to enter the brick and mortar space. And we've seen it across the board, tested in various ways. You've seen it with Macy's as they've explored it with the Market, which is basically a pad in the store where they bring in digitally native and other brands to test and see how they do in the store and connect with their shoppers. Story, a pad that changes every season to target a new theme. Nordstrom, which just opened in New York City, its women's flagship store, on their center core in the first floor, they basically created a pad that is essentially a pop-up. And they opened that up with Christian Louboutin, where they will feature a brand or a designer that's not typically found in the Nordstrom store, but that their consumers will relate and connect to, creating excitement to draw shoppers back to the stores. Lululemon tests pop-up stores in workout studios, which, that's where their customer is, so that's where they should be. And then Hermes has Aerismatic. So what do we think is the next retail disruption? And we call that re-commerce. So what is re-commerce? Re-commerce is taking basically a product and either reselling it, so extending the life of it, or renting it. You heard a lot earlier today from Jennifer about Rent the Runway and how they basically have been renting clothes for a decade now. So I'd say they were the innovators in this space, but that trend is gaining momentum. And it's said that, based on these statistics, that in 10 years, the rental market will grow from 1 billion to 4.4 billion. That's pretty rapid expansion and pretty good expansion. In fact, the expansion is driven not because retailers want to do it, but because the consumers are demanding it. 26% of consumers today are planning to spend more on rentals than they ever have in the past. And it's not just rentals, it's also resale. So whether it's the Real or whether it's Goodwill, it doesn't matter. People want to buy used items. And what's driving this trend is the younger generation. Millennials, Gen Zs, they're more sustainable. They want to be able to buy something that they can connect to, and they don't want to spend a lot of money on it. As their wardrobes keep changing in the midst of Facebook, Instagram, where they're posting pictures, you can't really post a picture of you in the same clothes 100 times anymore. So you need to be able to replenish your wardrobe, and the easiest way to do that is by renting it or buying used garments that you can then resell. What's important about the resale market is quality. So younger generations today are more focused on the quality of the product they buy because they want to know, will this have a resale value? Can I resell this? And brands really need to think about whether the quality that they're producing is going to attract shoppers because it will last longer or give them a better value at the end of it. According to ThredUp, 64% of women bought a used item. That's up from less than 50% prior. And this is an interesting chart. So there's a lot of colors on here. But if you look at the closet, the woman's closet, about 17% of it will be allocated in the next decade versus less than 10% a few years ago to rentals or used clothing. That's an enormous expansion. And that number could go higher. These are just rough estimates. It's interesting because now retailers have to rethink their stores, and brands have to rethink how they curate, make merchandise, since more room in a woman's closet will be allocated to essentially items that are used or rented. And that's the truth for the holiday too. More people want to shop rentals, more people want to buy used items for the holidays. And what does that mean for sales? So, when we think about re-commerce, if you were a retailer and your customers are renting more clothes or buying used clothes, what happens to the inventory that you've already committed to? It will probably get marked down. So retailers now have to either enter that market or they have to find another way to get rid of that inventory, mark it down, and that's obviously not sustainable. So what they're doing is they're entering the rental market, and they're doing it two ways. They're either doing it on their own or they're doing it with a third-party provider called Castle. Those that are working with Castle says that they have driven a 150% increase in consumers, and the profit margins for the rental business is anywhere from 20 to 30%. I mean, just think about that number. 20 to 30% is pretty astronomical for retail. We're used to seeing margins in the 6 to 7% range. So if you can get 20 to 30%, why not be in that business? And that's what we're seeing. You have Bloomingdale's, which just launched the List. You have Urban Outfitters, which does its own rental platform through Nuuly, and you have a bunch of others that are also doing the same thing. It's good to rent, it's good to make more money, but it's also good to be sustainable. So this is just an interesting stat. If all of us bought just one used item, this is how much we can save in CO2 emissions, in energy, and water, et cetera. And that's pretty mind-boggling when you actually see it and you read it, to see how much we actually consume when we don't buy used. And we've been talking a lot about the economy, and it's strong, and the consumer spending, but the reality of it is that the consumer at some point will turn. When that will be, we don't know. We expect a robust holiday, as we mentioned. We still expect modest growth in 2020, but this is just taking a look back at the last recession. And what's interesting here is the retailers that have done well in the past are still doing well today. So when you look at off-price dollar stores, discounters, they've actually fared a lot better in the Great Recession, and they're also faring well today, and we expect them to continue to fare well. But then when you go ahead and look at some of the more discretionary sectors, whether that's gaming, airlines, cruise lines, or even luxury, they actually drop the most in a recession. So as you think about if there is a consumer downturn, what sectors are most exposed, I'd point you to this because I think this kind of paints the picture a lot better.